Today we are talking about Intel stock, and in this video I'm going to walk you through my complete valuation process where we will do a quick company health check, we will run the numbers and do the intrinsic valuation, and we're going to check to see if any super investors are currently investing in Intel. And to let you in on a little secret, Chris and I are currently investing in Intel, so by the end of this video I'm going to give you a peek at our portfolio and show you the two ways that we are currently building our position. To kick things off, I want to give a big shout out to Ahmed Aziz, who recommended that we do Intel for our next valuation video. Let's dive right into the company health check. So as value investors, we take the approach that we are not just buying shares that randomly appear on a computer screen. We're actually thinking of ourselves as partial owners of that business. And so the first place that we have to start is understanding the fundamentals of the company. And these fundamentals are facts. These are financial facts and numbers that we can look at to give us a better understanding of how management allocates capital. We can understand their growth potential. We want to look at things that will give us indications about how they handle their debt and how they might respond in an economic downturn. And we also want to see how they preserve shareholder value. So the first thing that I want to look at is the company's ability to pay off its debt. And the way that we do this is we look at the cash flow and how many years of cash flow it would take to pay off the current long-term liabilities. The lower the number, the better, but as a rule of thumb, Chris and I really like it when a company can pay off their long-term debt in 5 years or less. And if they can't, then that's a trigger for us that we need to dive deeper and learn more. So let's head over to morningstar.com to see what we can find out about Intel. Once I type in the ticker symbol, INTC, I click on the main page for the company. From there, I'm clicking on this button that says Key Ratios, and then here for full key ratios data. I can see that last year Intel had nearly $21 billion in free cash flow. But if we look further back, I can see that that is higher than other recent years and the trailing 12 months. So to be on the safe side, I'm going to use $16 billion. So I'm being conservative with $16 billion, but the reason I feel comfortable with it is because it's roughly the 5-year average, and it's a number that I'm confident that they can consistently hit in coming years. Now we're going to scroll down and click on this tab that says Financial Health, and we can see that they currently have a little under $29 billion when you combine long-term liabilities and long-term debt. We take $29 billion and divide it by $16 billion, and we get 1.81. So this means that Intel can pay off their debt in less than 2 years, and that's a great sign. Moving on, now we want to check to see if they have a strong return on invested capital, and Chris and I like to see at least 10% for this number. Okay, let's get back on Morningstar and click over to the Profitability tab. We can see that in 2020, ROIC was nearly 19%, and if we look at the trailing 12-month, it is at nearly 18%. That's another good indication. Now let's talk about growth. So we like to see that their revenue, earnings, and most importantly, cash flow are generally trending upwards. So let's scroll back up to the top of that same page where we see the financials and key ratios. And we are looking here, here, and here. Important note, earnings are labeled as net income on Morningstar. Looking back 10 years, their revenue was $54 billion, and last year it was $77.8 billion. Check. Net income was $12.9 billion, and last year it was $20.9 billion. Check. And their free cash flow was at $10.2 billion, and last year it was at $20.9 billion. Another check. The next thing that we're going to look at is the shares outstanding because we want to make sure that they are not diluting the value of the shareholder. Now, something that companies can do sometimes is that they can issue new shares of the company to generate cash, and they use this cash to either grow the business or to maintain operations. Now, Chris and I much prefer a business that uses its cash flow in order to maintain the business and to grow, not issuing new shares. We are still on the same section of the website, and we can look here to see that 10 years ago, their shares outstanding were 5.4 billion, and today they're at 4.1 billion. So this tells us that they have actually been buying shares back. And what's cool about this is that over the past 10 years or so, Intel has been pretty fairly priced. So in my opinion, the company has been getting a good deal on the shares that they have been buying back. Again, this is another great sign for our health check. And the last thing that we want to check on is the security of our dividend, which currently is yielding 2.76%. We're going to compare the amount paid in dividends with the same free cash flow number that we used against their long-term liabilities earlier in the video to see how comfortably they can pay out these dividends. We're still on the same tab, and we can see that the trailing 12 months dividend is at $1.37 per share. We multiply that by the shares outstanding, 4,097,000,000, and that tells us that in the trailing 12 months, they have paid out $5.6 billion in dividends. If we compare that against the conservative $16 billion we're using as their cash flow, it tells us that they are only using about 35% to pay those dividends. I'd say that means the dividend is pretty secure, and that's our final check. So as far as I'm concerned, Intel has a clean bill of health. So now we can move on to the valuation. Essentially, doing a company valuation is your attempt to predict future value in order for you to decide what you are willing to pay for those shares today. It involves looking up key numbers online, plugging those numbers into a few calculations, and making some informed judgments. And determining the value of a stock before you purchase it is so important for protecting your investment. And in fact, if we look at the history of Intel, we can actually see a perfect example of how you can overpay for a company, even one that has excellent growth and good fundamentals, if you don't understand the business and calculate its intrinsic value ahead of time. If we went back to September of 2000, at the height of the dot-com bubble, you would have paid $75 a share for Intel. Today, it's 20 years later, and Intel has more than doubled both their revenue and earnings, something that is a sign of a wonderful business, and it's currently priced at $50. Remember, price is what you pay and value is what you get. We want to know the value of a business before we invest in it, and we don't want to be swayed by irrational market exuberance. And my final note before we dig into the valuation is that we strongly believe that in order to consider investing in any business, it needs to be one that you understand, it needs to be one that has honest and capable management, and it needs to be a business that has a strong, durable competitive advantage. And this is what is going to protect your investment into the future. All right, are you ready to crunch some numbers? Today we are going to do a valuation of Intel using a discounted cash flow calculation. To run this calculation, we will use a terminal multiple after 10 years, meaning that we are going to forecast the cash flow for each of the next 10 years. We will assume that we will sell the company at the end of that 10-year period and collect a lump sum. Then we are going to apply our desired rate of return to discount all of these cash flows and figure out what price we are willing to pay for the stock today. And this method requires 4 key numbers: trailing 12-month free cash flow per share, expected 10-year growth rate, 10-year future cash flow multiple, and your desired rate of return. In order to start populating my valuation cheat sheet, I need to figure out what was the trailing 12-month free cash flow per share. So let's head back over to Morningstar so that we can gather that data. We're still on the key ratios page, and we're just going to scroll down and look at the free cash flow per share figure under the TTM column. This number is missing on Morningstar for some reason, but no worries, we can still figure it out. We simply take the total number of 17.326 billion and divide by the number of outstanding shares, which is 4.097 billion, to get 422 per share. Now I'm going to show you our valuation cheat sheet and enter the data that we have thus far. Okay, this is where the real work begins. Now it's time for us to make an educated guess on the future of how this business is going to perform. And in order to do this, I'm going to look at 10 years worth of growth history in order to make a judgment about what I think is going to happen in the next 10 years, and for me to finalize the growth rate number that I want to use and plug into my formulas. Important side note, I want you guys to know that past performance is no guarantee of future results. So it's not enough just to run the numbers. Whatever assumptions you make, it's really important to back those up with additional research. And you can do this by reading letters to shareholders, by watching interviews that management gives, and by listening in on earnings calls. When it comes to value investing, we really want to understand the story of the business just as much as we want to understand the numbers of the business. All right, let's get back to historical growth rates. Now, there are 2 ways that you can calculate this: the quick way and the more complete way. I want to be super thorough in my valuation of Intel, so I'm actually going to look at 3 different growth metrics before I settle on the final number of the growth ratio that I'm going to use in my formulas. We're taking a look at EPS, FCF, and book value per share. Let's start by doing the quick method, where we are going to use the compound annual growth rate formula that you see here on the screen. We like to embed this formula into our Excel sheet, and then using the data we pulled from Morningstar, we start to plug in the numbers so that the formula can do its job. For earnings per share, we are using $2.39 for the first value and $4.94 for the final value. This gives us 8.4%. For cash flow per share, we are using $1.83 for the first value and $4.73 for the final value. This gives us 11.1%. For book value per share, we are using $9.22 for the first value and $18.35 for the final value. And this gives us 7.9%. Okay, so that's interesting. They're roughly in the same ballpark, and if you average out those three numbers, it gets you 9.1%. But the problem that I have with this particular methodology is that it looks at data from today and 10 years ago, and it ignores all of the data in between. So my advice to you is that if you're only going to use this formula, you need to make sure that the data that you plug in are not outliers, because if they're outliers, that can really mess up your valuation. And with that, let me move on to the second way to calculate that growth number, which is to plot it and chart it in Excel. And let me show you exactly what Chris and I do. First, I plot the last 10 years' results. Then I use these numbers to create a scatter plot chart. I add an exponential trend line, and finally, I make sure to label the trend line with the equation. The exponent of that equation is the compound growth rate of the earnings. So I really like this method because it very easily lets me see if there are any wonky outliers that are going to mess up my results. And if I do find outliers, it's my trigger that I need to go in and research and try to understand what happened those years. And if they make sense to me, then I can continue on and value this business. But if it's super weird and it doesn't make any sense, it's my cue that I need to put this in the no pile and move on to value my next company. But there's an important side note here. This method only works if all of your numbers are positive. Okay, and when we pull the numbers from the charts, here's our results. Earnings is at 9.6%, FCF is at 10.5%, and book value is at 7.5%. So again, all of these numbers are roughly in the same ballpark. That's good. That shows consistency. But because I'm conservative and also because we are doing our valuation based on future cash flow, that's the one that I'm going to give the most weighting to. And so the number that I'm going to stick to for my calculation is 7%. And that's what we're going to use for the rest of this video. All right, now we need to settle on the future cash flow multiple that we think Intel would sell for 10 years from now. Or in other words, the amount that we think someone would be willing to buy that company 10 years from now. And for this, I'm going to use 10, which is kind of a conservative number, but as a rule of thumb, it's pretty solid across industries and across different market cycles. So 10 is what we're going to stick with for this valuation. Now, the last number that we need to decide on is our desired rate of return. So for Chris and I, we like to use 15%. And for some of you, that might seem high. For some of you, that might seem low. Investing is a really individual process. So ultimately, you're going to have to decide on the rate of return that works best for you. But in Chris and my perspective, we know that if we were to just invest in an index fund, we would roughly get around 10%. And so we want to get more than 10%. If we are spending all of this time valuing a company, we need to get more out of it. And likewise, if we set it too high, like let's say we set it at like 30 or 40 or even 50%, it might keep us out of the market. It might prevent us from actually, buying any stocks. So for us, 15% is really that sweet spot, and that's what we're going to use in our calculations. So to review, let's check out our cheat sheet. TTM free cash flow 422, 10-year growth rate 7%, FCF multiple in 10 years equals 10, and the desired rate of return for us is 15%. And now that we have these four numbers, we can do our valuation using our Excel spreadsheet. Let's grow our trailing 12-month free cash flow per share by 7% over the next 10 years like this. Year 0, we put the TTM FCF per share of 422 to get 1 year. We multiply 422 by 1.07 and get 452. Then we take 452 and multiply it by 1.07, and then so on and so on and so on for all 10 years. Now we can multiply our 10-year FCF per share value by the multiple of 10, because remember, we are assuming that we would sell the business at that time for a multiple of 10, and this gives us 8301. Okay, this top row is done, and now we bring each of these cash flows back to today's value using the present day formula seen here, and which we have also embedded into our spreadsheet. Okay, now we are going to add to get the sum of all of these discounted cash flows to give us a total of $49.52 per share. And that's what I'm willing to pay for Intel shares today. And at the time that I'm filming this, Intel is currently trading at $50, so in my opinion, it's a buy. And just for a little extra validation, Chris and I always like to head over to Dataroma and check to see if there are any super investors currently investing in the company that we are valuing. It's not necessarily a deal breaker if there aren't, but it's always nice to have that extra assurance. Currently, there are 9 super investors invested with a bit of a mixed bag of activity. A couple are reducing their position size, and others are adding and starting their position in the last couple of quarters. All right, now finally, as I told you, Chris and I are currently investing. So as promised, it's time for me to crack open our portfolio and show you the different purchases that we have made in order to build our position. Here it is. We bought 100 shares on the 28th of October for $48.97, and we have sold put option contracts expiring on the 17th of December at the following strike prices. 2 contracts at 50, 2 contracts at $47.50, and 5 contracts at $44. Each contract requires us to buy 100 shares of Intel if the price drops below the contract strike price. But for this, we got paid a premium of $636, which we get to keep whether we buy the shares or not. So we're doing this to continue to build a position in Intel. It reduces our cost basis, which in return reduces our risk. And on top of that, we are generating some nice cash flow while we wait to get put shares at a price that we're happy to buy them. All right, guys, this video is just about finished. But before I go, I want to ask you a question of the day. At which price would you buy Intel? Let me know in the comments. All right, guys, that's it for me. Thank you so much for watching, and I really hope that you found this video useful. And if you did, it really helps our channel if you like and subscribe. And if you like this one, I think you might also like our Facebook video that you see here, and which I will link in the description below. But remember, I am not a financial advisor, and I am definitely not your financial advisor, so make sure that you are making your own decisions when it comes to your investments. Earn more, spend less, and invest the rest, and I will see you next time.